Economist here. Doing this from the work truck today. Pretty cool, right? Sitting up here in the cab of the big old truck. Thought I'd talk about the Federal Reserve and the interest rate cuts that they are going to do to the Fed funds rate with promises of more rate cuts coming into the future. Now, I think about what it is that has been delivered with the message, or the message that has been delivered with the rate cuts as the appropriate monetary policy to follow. It's not so much about the rate cuts as much as it is about the message that is delivered with the rate cuts. Now, what I have heard coming from the few articles that I read just before I started this video, because I just started my lunch break here, is that the Federal Reserve is concerned about the labor market deteriorating further into the future and the idea of inflation that is going to be elevated at the same time. Now, this is kind of like a crossroads that the Federal Reserve is facing. One, right, the labor market is deteriorating, which means you want to try and support the labor market by lowering interest rates. But at the same time, we have this inflationary pressure, which is forcing the Federal Reserve to keep interest rates elevated in order to combat the elevated inflation that is going to be persistent going into the future. Or at least the idea with the credible threats of tariffs and all that being pushed into the mainstream media narrative that it's going to keep the inflation or the inflation expectations elevated. Now, the promise of more rate cuts coming into the future, this is from the dot plot. Now, the dot plot is an idea of where it is that the Federal Reserve believes, or the members, the voting members of the Federal Reserve believe that interest rates should be going into the future if these conditions continue the way they are. Here's the thing. The conditions never stay the same. Never, ever do they stay the same. So the dot plot is really not any kind of signaling or any kind of forward guidance. In fact, I've never seen the dot plot really be that accurate to forecast what it is that the Federal Reserve is doing. So when I see the message that is being delivered, that there is going to be more rate cuts coming into the future, I think that right there will be pushed as the most credible threat going into the people's perceptions, the markets, the belief systems, is that there is going to be more interest rates coming because of the signaling that has taken place from the dot plot. Now, again, this isn't like the Federal Reserve is trying to forecast exactly what it is that they are going to do. It's what they are forecasting based on today's economy, today's conditions. Like, that's the easiest way to understand that. The market will receive that information differently than what is the actuality, right? So the interest rates may not come down, but if the market believes that they are enough, it will create an economic environment as if those rate cuts had happened. Now, this is something that I have been trying to share on this channel for quite some time, that they are not necessarily using forward guidance as much as signaling, jawboning, or credible threats. These are different this is different, right? Forward guidance is when the Federal Reserve says, we are going to cut at the next meeting, we're just not sure by how much, right? Signaling is like what we are receiving right now with the dot plot. There's no promise to cut. They haven't said, hey, we are going to cut at the next meeting again, right? The expectations of the market based on the dot plot are that they will be cutting, is that they will be cutting at the next meeting. That is not the same thing, right? So one of them is forward guidance. When the Fed comes out and delivers the message, we are going to do this at the next meeting, we just don't know by how much, that might be a forward guidance statement. Signaling is what the mainstream media is now doing with the dot plot. Very different, right? And now, to understand that this is a form of manipulation, straight up. I mean, this is not something that the Fed even keeps secret. A lot of times when people hear me talk about the credible threat, they say, yeah, man, everybody knows about forward guidance. That is not the same thing. It's not, right? And I think a good example of the difference between the two is when the corporate debt lending facility was established during COVID. See, they put out this idea that they were going to have this special purpose vehicle, which is an entity that is separated from the Federal Reserve and the Treasury. And they were going to fund it with hundreds of billions of dollars and then use that special purpose vehicle in order to purchase corporate debt. The information got delivered out there to the mainstream media. It blew up all over the place. People started front-running the Federal Reserve by buying into corporate debt, and the Federal Reserve and the special purpose vehicle, the corporate debt lending facility, hardly bought any corporate debt at all, because most of those corporations found all the funding that they needed directly from the market, with the expectation that the Federal Reserve was going to be buying into corporate debt. The credible threat alone was enough to provide all the funding to these corporations. They gorged on incredibly cheap debt during that time. That wasn't forward guidance. That wasn't like the Federal Reserve going out there saying, hey, we're going to be buying corporate debt, so you should run out there and front run us. They didn't even have the facility up and running. They didn't even have it up and running when the corporations had already found all the funding they needed. The idea of that facility being set up was enough. And that is the difference between the two. When the Federal Reserve comes out and says, we are going to do this at the next meeting, that's forward guidance. Credible threats, or what I like to call credible threats, the signaling, the jawboning, this is when they put an idea out there of what it is that's going to be coming into the future, regardless of if they take action or not. Right? The corporate debt lending facility was a great example of that. It's pure manipulation. It's gaslighting at its finest. And when you start to recognize it and see it, then you can position yourself and deal with the situation in a much more appropriate fashion. Like I have been saying it for some time, the Fed has pushed out the idea that they will be cutting, right? There was zero doubt in my mind that they were going to be cutting at this meeting, because they had it so well stated within the mainstream media narrative that it would be very difficult for the Federal Reserve to not cut. If they didn't cut, there would have been such an unwinding of the positions that everybody had taken, because the market had already priced it in. That was due to the message that was delivered. That wasn't forward guidance. Forward guidance is when they say they were going to do it. They just didn't know by how much. This was a very real possibility that they wouldn't have cut. However, if they didn't, the market would have been very shocked by that, and they would have had quite a unwinding of the positions that people had already committed themselves to, based on the idea that the Fed was going to be cutting rates. So now when I think about the message that is being delivered right now, labor market deterioration and the concern about inflation. Well, inflation isn't that high. Now, is it above the 2% target? Sure. But really, they're going for a 2% average over time. So if they ran at 1% to 3% consistently forever, they would hit their 2% average, right? Are we just moderately above 2% at this point? Sure. Is it high? Sure. Above the target. Is it outrageous? Is it so concerning that there's hyperinflationary scenario coming? I don't think so. Like, sure, tariffs could create a situation in which that we have more inflation, but the idea that we were going to have some rampant high inflation, that doesn't seem to be that persistent in the economy. Like 2.9, 2.7, that's not that high of an inflation. And the labor market is still on a historically low unemployment chart. Like if you look at the unemployment chart of history, it's like not that high. Like historically looking at it, it's pretty low. So when I think about the major concerns that the Federal Reserve has going into the future about a deteriorating labor market, yeah, I mean, it's getting pretty bad out there for a lot of people, especially if you lost your job at some zombie corporation getting paid $100,000 a year, and now you're flipping burgers because the service job is the only thing you can really find out there. Yeah, that sucks, right? I get that, man. I mean, it's a bad position to be in, but even if you're got a bad job, you got a job, and if you got a job, you're not unemployed. That's different. Right? Yeah, it's not a good job. That sucks, right? Not even a good job is good anymore. Good jobs suck. So the idea that the labor market is deteriorating, well, yeah, no kidding. The day job has been deteriorating for quite some time. And because people don't make a living wage doesn't mean that they're unemployed. They're employed. They just can't make the job work for them in any kind of significant fashion that says, hey, man, look, I got a decent life, or I can increase my consumption. Like that part, yeah, that's not happening. But the unemployment isn't rising significantly. If you look at it on a historical chart, it's still really low. And inflation, well, I work retail for a living. Right? And although we do have some products that are increasing, and we've had notice that there's going to be products increasing, it's not dramatic. In fact, I couldn't even tell you one item out there that is so significantly increased in price that I can't believe, like, these tariffs are just destroying. Like, I cannot find that. We got an announcement just recently from one of our suppliers that they're going to be increasing all the fasteners by 10%. Well, that's not the first time they've done this. Like a few years ago, they did it at 10%. And, years before that, they did it at 10%. And to do it at 10% now probably isn't that out of the realms of like normal. This kind of normally happens. Are they blaming it on tariffs? Absolutely, they are, right? It's so much easier to blame it on something than it is to say, hey, guys, we don't have anything to blame it on. We're just going to increase our prices. Yeah. Now, here's the funny thing about it is that there's competition now coming in saying, hey, all those nails, we supply them and we supply cheaper. Oh, really? Yeah. It's because this is the new supplier that's coming in from a different area. Maybe it's not coming from China. Maybe it's coming from India. Maybe it's coming from Vietnam. But there's going to be competition who's coming in saying, hey, those guys increased their prices. Would you like to stock our cheaper product here, our generic nails, our generic fasteners? Somebody's going to come in and replace those expensive ones with something cheaper. Right? It's just a matter of time. I've seen this happen on a lot of products out there. Fiber cement siding did something very similar to that. Their prices went way up during COVID to the point that it was just like almost doubled, if not tripled in some places, only to find that the fiber cement price of the siding is now come down quite a bit since the COVID peak. Has a new name, has a different look. And I'm thinking to myself, is there any difference in this product other than the name and the look of it? No, they needed a cheaper product to be competitive out there against everybody else who is now providing siding, and they couldn't do it with these elevated prices. Well, if you have elevated prices out there, how do you just go and lower your prices? It's very difficult, but if you just provide them a different product with a new name and a new look, right? It's the same thing. It's just cheaper now. Right? This is happening quite a bit. I see this a lot. So I do wonder about the idea of inflation that is going to be persistent going into the future when I think about the credible threat of tariffs being alleviated. Like if you can alleviate the tariff problem, then all of a sudden the idea that you need to raise prices to combat the inflation, well, that will no longer be a decent or reasonable excuse. Well, we may find out here very soon that all the tariffs are illegal. I mean, we're finding out that Trump can't do a lot of the stuff that he said that he could. How many people believe that he was going to fire Jerome Powell or Lisa Cook or, anything else out there? He can't do any of that stuff. Right? And I would not be surprised at all if the Supreme Court came back and said, yeah, all these tariff ideas, that's all illegal too. Sorry, no. All of a sudden, the credible threat of tariff alleviates. We got a ripping economy coming from that. You know how many people are holding back investments, holding back on hiring, holding back because they are worried about what it is that tariffs are going to mean going into the future? Well, if you alleviate that problem, why wouldn't they jump into the game? People want to invest. This is what I find very interesting. A lot of times when I talk on this channel is that people are saying, oh man, all this hell is going to break loose and all this, problems they're going to be faced. And I'm thinking to myself, for 80% of the people, that's probably right. That's probably going to be the case for 80% of the people out there, which is the majority of the people. And I think a lot of times when we look at 80%, we think that's the economy. But that's not what the Federal Reserve is looking at. It's not what the government is looking at. They look at consumers. Okay? Can you be a consumer? Are you a good consumer? Can they lower interest rates and get the average everyday person out there to borrow money so that they could go out there and consume? See, the United States is trying to produce a consumer. We don't produce stuff. Like, it would be awesome if we did. It would be awesome if we manufactured wonderful products that we could send out there to the world and the world would send us their money. That is not what we do here in the United States. We are custodian of the world reserve currency. That means we have to import stuff and export money. Not import money, export money. That's how a world reserve currency provider provides it, is by buying stuff, right? You buy stuff, you export money. So the United States, their job is to produce a consumer. But if you have 80% of the people whose wages are not a living wage, they don't cut it, and even if you were to give them a raise, it wouldn't help them out that much because they are already debt saturated, then lowering interest rates doesn't really help this group out. You could lower interest rates and get the corporations out there to start investing into their companies and start hiring people. But even if they hire them, it's not like this added labor is going to increase the consumption, because the increase in labor doesn't provide any kind of extra consumption to the economy. Those 80% of the people just can't cut it anymore. So now this is really where the problem ends up being, is that 20% of the people are the consumers. 10% of the people, 10% of the top household incomes do 50% of the consumption. Back in the 90s, it was like 35% of the consumption. That number is not shrinking, it's getting worse. Like, sooner or later, 10% of the people will be doing better than 50% of the consumption, and that's going to continue. There's literally nothing that can change that. People who wish and hope and dream and pray for somebody to come in and change that are not understanding the underlying economic forces that are at play. If you have ever increasing amounts of new money and you have ever increasing amounts of debt issuance, if you are lowering these interest rates, you are going to create more economic activity out there with debt issuance, which is going to then move into a luxurious experience, irrational exuberance, and this will separate the rich from the poor. Very little doubt in my mind. In fact, people who say that it won't do that cannot find any example of history of that. They are delusional. Every example of history has shown, if you increase the amount of new money, if you increase the debt issuance, you are going to increase the amount of separation between the rich and the poor. Very little doubt in my mind of that. All right, what are we at? 17 minutes into it. Oops, sorry guys, I got you kind of propped up here on this arm of this truck door here. Okay, followers, love them some leaders. We are living in an era where fear is on all sides and coming from every bit of social media. Yeah, and this is the thing. When people are this fearful, it's time to get greedy, right? Be greedy when people are fearful, when they're like, oh man, this is going to collapse. That's garbage. This is all the other stuff. This is where I start really paying attention. It's like, okay, now where do I position myself in this? Because when people start saying, oh man, this is the worst ever. This is horrible. This is like, death and destruction and chaos and stuff. That's the time to position yourself, right? So the more fear and anxiety and issues that I see people are facing, this gets me more into the position of paying attention to say, hey man, at some moment here, I better deploy my effort into a position to take advantage of it, right? Be greedy when people are fearful, and fearful when people are greedy, and the fear is running rampant now, all right? That reminds me, Deja, gotta share the links to Zuber's event in Vegas in February. Absolutely, all-nighter. Share them links with everybody. If you have never been to Zuber's conference, the One Rental at a Time conference, you are missing out. It is absolutely excellent. You will, out of all the conferences I've ever been to, Zuber's is by far the best at network, grouping, community. I mean, all of them are really good about networking and community, but Zuber's is like a different level up, right? It's definitely a good one to go to. All right, people saying JP too late, Jerome Powell's too late. Well, Jerome Powell is only in charge of his one vote, so maybe the FOMC together is too late, but to blame Jerome Powell is really just showing a sign that, you don't really understand monetary policy. We can't blame Jerome Powell, right? If we are going to address monetary policy, let's address it in a way that says, hey, we need to focus on the appropriate people, which is 12 voting members, 5 alternates, and two advisors. They make up the FOMC, the Federal Open Market Committee. Jerome Powell has 1 vote, and he is a spokesperson. Did it say Jerome Powell didn't do it? That, to me, that is really not focusing in on what it is that really needs to be paid attention to, and that is the words coming from the voting members of the FOMC. All right. Did he do exactly what they planned to do with the outcome they wanted today? I believe that the interest rate cut was definitely well communicated into the mainstream media, and it was delivered with a message. That message is, we are concerned about the labor market and elevated inflation, which is 2 opposite directions. This now leaves it open-ended if you really think about it. Now, to me, both of these concerns, these major concerns coming from the Federal Reserve, are not really that threatening. Unemployment is low and inflation really isn't that high, right? I mean, to me, I look at it and I'm like, your dual mandate of low employment has been achieved, and your other part of it of keeping inflation low with stable prices is really based around an average inflation of 2% over time. So if you're running at 1% or 3% consistently, then you are achieving your dual mandate. To me, they are in line with what it is that they want to be at. Now, they deliver a message of concern because they want to manipulate the mindset of the market so that they can get the outcome that they are looking for. So they will, we're really concerned about labor. We're concerned about inflation, and we're going to push this credible threat out there for the people to internalize so that they can then use their words to guide those markets. But there's not that big of a concern. Right? I mean, people want it to be. They're like, oh man, you don't have any idea on how bad the labor market really is. And I'm like, I've talked about this for quite some time, that all these zombie corporations were going to lay off a bunch of people. They weren't going to get bailed out. And then all those people were going to go to work at the service industry flipping burgers. And I've been saying this for years because that is what's happening. And I know it's concerning for a lot of people out there to say, oh man, all these layoffs, this is really bad. And I'm thinking to myself, yeah, what's even worse is taking a job flipping burgers. So they cry about the layoffs, but then don't cry about having to go get a job, right? They cry that the job doesn't pay enough, that it's a service job, but it's the job and it's there and you could go work it and then you wouldn't be unemployed. And that's one of the reasons why we haven't seen unemployment rise significantly. They're not worried about 80% of the people. You can have a good job or a bad job that makes zero consequence to the Fed and the powers that be out there when it comes to creating a consumer. Everything comes down to the top 20% of people. If they can focus in on them, they're the ones who are doing the consuming. That is what it is that they are going to put their effort towards. Flexible average employment targeting. Well, they have, I don't know if it's necessarily flexible average employment targeting, but they do have something called the neutral employment rate, where the employment at a certain level will start to create an inflationary scenario. Like if you have enough people working, well, that neutral employment rate had gotten very close to zero, neutral unemployment rate. So you can run unemployment all the way down to zero and it would never create the inflationary scenario, not since the great financial crisis. This is part of the Federal Reserve's broken monetary system. So this is why they're not concerned about creating an employment situation getting too hot, right? They could let employment run as hot as they want. Labor market could run as hot as they want from the Obama administration through the Trump administration leading up into COVID. They had some of the best jobs numbers in history and could not produce an inflationary scenario because of it. Unemployment can run low, hot, whatever. That isn't important to them anymore. It used to be important. Like if they could get people working, then they could get people to start spending money, and that spending money would create an inflationary scenario. But since the great financial crisis, that failed them. So they're not doing that anymore. What time is it? Alrighty, guys, a few more minutes, and then I gotta call it quits. All right, 294 people watching, right on. Office chair from China. Obviously, I was watching on Amazon. $55 a week ago, consistently 85 now. 55 plus increase. Huh. You need 200,000 here in California to be middle class. See, that's incredible to think. Like $200,000 a year. Like I remember, like when I was a kid, man, if you could, like, I mean, even just a few years ago, really, I was thinking about it. If you could make $100,000 a year, to me, that was like a lot of money. Like you could have everything you could ever possibly have wanted if you were making $100,000 a year. And then I made $100,000 a year, and I thought to myself, man, it's not enough. It's not enough. Like, I mean, I can make it work, but I drive an old car. I drive, I don't have any fancy things. I don't really have any debt. I don't like all this stuff, and 100,000 barely makes it. It barely cuts it through. Now, I did find out last year that I live in the tenth most expensive place in the entire nation, with populations 10 to 50,000 people. So I'm in one of the most expensive areas in the country to live, and I didn't realize that growing up here. I mean, I knew it was getting expensive. I knew it was getting pricey. I knew the conditions of the people were changing here. Like, the population became from working class individuals to retirement community and hospital district and remote workers. And this changed, the whole demographics of it changed. And when I realized that, I was like, wow, holy crap, no wonder why a day job doesn't do it anymore. Right? You just can't compete. All right. I remember when $10 an hour was for elite. Yeah, I remember like when, well, maybe not $10 an hour, but $15, $20 an hour. If you were making that kind of money when I was a kid, you were like some doctor, some like fancy professional or something like that. It was like an amazing amount of money. I mean, at least to me, it would have been. All right. With this news, why does the dollar weaken against other currencies? Well, if you think about it, if the idea that the Federal Reserve is going to be easing monetary policy, that weakens the dollar. All right. So if you if you tighten monetary policy, that strengthens the dollar. So even with the concept, the perception, the credible threat that the Federal Reserve is going to be lowering into the future, this will start to ease monetary policy. If you ease monetary policy, you are weakening the currency. By weakening the currency, you are able to have more economic activity with the little bit of exports that you do have, or we do have here in the nation. This will become more affordable to the other nations out there to buy from us. So weakening the currency has, like, the race to the bottom. This was like during the great financial crisis, and even during COVID, it was to see who could weaken their currency the most, right? To outcompete everybody else in their weak currency, to make sure that your exports are the ones that are most sought after. I make 30. What was that? I missed it already. I make $30 an hour, and that's minimum wage basically. M Rider 777. That's like, I mean, that's a hell of a lot more than I make per hour, and yeah, it's not enough. Delivering lumber in the lumber truck today, Simon? No, I'm just sitting in the truck today. So what do you think of gold and silver now? I I haven't changed my feelings about gold and silver. Gold and silver are an insurance policy. I don't look at them as anything other than an insurance policy. I don't really think about what the price is of it. I just think about how many ounces I have. I think about stacking more into the future. And if I had my wish that it would stay under $30 an ounce forever until I'm 80 years old, and then it'll go up to $500, $1,000 an ounce, and then I can sell off all my silver and retire happy. I don't have any expectations of silver or gold to do anything other than what it does, right? And it gives you a position outside of that third party claim. So if the financial market's screwed up, if governments are screwed up, if the whole economy starts to get screwed up in every way, you have something that is outside of that third party claim that you can protect, you can hold on to, carry it to the other side, whatever it is that you got going on. But to me, like, buying into it with the idea that it's going to shoot up in price and then you can sell it off. Yeah. I mean, I guess there's a position that you can take with that. But if that was really my intent, I would probably move into like position inside of the miners, because you'll probably get much more of a return off of the miners than you will off of the physical metal. But buying the physical metal, there's no greater insurance policy. Literally, there's nothing else out there that is as good. Yeah. All right, please hit the like, everyone. Thank you, Brody. Thank you, All Nighter. You guys are doing awesome. All right, it's hard to give up that feeling that you're buying into something that's at the top when gold seems too expensive, or so expensive right now. Well, I dollar cost average. So I don't like, even if you were buying at the top and it drops, then you just add to your average. You just take in more position and lower your average. So to me, like, I don't really think about buying at the top. Like, I wouldn't necessarily buy purposefully when it's at the top. I might hold back and just wait and see, because I don't generally buy at the top of the market. I will usually wait. But like, even with Bitcoin, I don't have any problems. Like, I just recently bought some and it's pretty high right now, but I've been dollar cost averaging for so long that I couldn't even tell you where my average is. And again, I'm just adding to my position. I'm not really thinking about that $50 that I've been putting in once a week being anything other than a dollar cost averaging position that I take in Bitcoin forever. Like, that's literally what I plan on doing forever. So buying at the height of the Bitcoin market seems very scary. But when I asked Lynn Alden, how do I know when to buy Bitcoin? When do I time it? And when she said, you got a dollar cost average for 4 years, even if you start at the height of the market, if you do it for 4 years, there's never been a time in their economic models, anything that they have studied, that shows that you would be down, you would be up. And so when I heard that, I mean, I'm not nearly as smart, and it's something as simple as dollar cost averaging for 4 years. So I did that. I used Cash App. I dollar cost averaged for 4 years and absolutely killed it in Bitcoin. Did so well, right? And Coinbase at the same time. And so I think to myself, man, that's the easiest way. Like, I don't have to think too hard about it. I don't really have to do anything other than keep my expenses low, my income high, and then dollar cost average into the positions in which that I feel is most appropriate for me. And it works so well. All right. I don't try to time the markets. Like, there was times when I tried to do the whole day trading thing, and there was days I would make money, but for the most part, I just lost money. I just didn't do very well at it. When I gave up on that and just started dollar cost averaging and just like cut back on my expenses, increase my income, and then just drop some money every time I get paid, I pay myself into those portfolios. I now all of a sudden find myself with a decent, like, in my opinion, considering that I had nothing just a few years ago, I have a decent position now. Something that gives me a lot of feeling of security and, idea that I might actually have some sort of retirement at the end of this. Like, I actually feel much better about everything that I have going on, way better than I ever felt in my entire life. And this is during a time in which that people say, oh, dude, it's the worst in history. And I'm thinking, wow, man, I'm glad I did what I did, because this isn't the worst for me. It was way worse before. Right? It was self-inflicted, but it was way worse before than it is now. Am I done here, guys? Do I got to go yet? Oh, bummer. Okay. Lunch break is over. Thank you so much, everybody, for being here. We got quite a few people watching. 336 people watching with 78 likes. Do me a favor, go hit that like button while you still have a chance before I end the live stream. By hitting that like button, you'll get the YouTube algorithm to pick up the video and spread it around for more people to join in. And also, this Saturday, coming up, what is that, the 20th, right? Yeah, the 20th, we will be hanging out down at the Coffee Girl on Pier 39 from 10 till about noon. If you want to come to Astoria and hang out and have a conversation about economics and meet some pretty cool people, we're going to be hanging out at Coffee Girl for a meet and greet at the Pier 39, just, on the east side of Astoria between 10 and noon on Saturday, September 20th. All right. Hope to see you guys there. Uneducated Economist, you let me know.